Just as the new Finance Minister Tito Mboweni tabled his first medium-term budget policy statement, the JSE and the Rand showed some weakness, the bond market spiked, and there were some suggestions that perhaps we tipped over the edge and that the ratings agencies may very well come around with a big stick. Things started on Thursday morning on a negative note after a rout in New York on Wednesday night. But things have calmed down a little bit since then. Tito Mboweni, frighteningly honest, sending apparently the right message in committing to bring down, eventually, the country's debt-to-GDP ratio. I'm Bruce Whitfield. This is Taking Stock. With us to wrap up the month that has been. It is the last Thursday of October 2018. Chief Executive of Vestact, Theron and Rayhaan Joosub from Sentio Capital Management join me to look at the big stories of October. And there is no bigger story right now with the medium-term budget policy statement, some 36 hours old, into the good, the bad, the ugly, and the really, really bad-looking Paul Theron. I have to go ask him that question, I suppose. When it comes to the medium-term budget policy statement, in the corporate world, when a new CEO takes over, they do something called kitchen sinking. They throw everything in the kitchen sink at the financials of a business. Did Tito Mboweni kitchen sink the South African economy when he delivered that medium-term budget policy statement this week?
Maybe, but I must say, Bruce, I was deeply unimpressed. I was deeply disappointed by that. You know what this country needs right now is serious economic leadership. All I got was a sense that it's the same old, same old. In other words, you know, we're not really collecting enough money. Our corruption problems continue. You know, what is this government actually good at? They're definitely not good at running the healthcare services or the schools or the police. They can't even collect money properly. We see all these problems at SARS. They can't even give it away properly. You know, the social grants are in an absolute state of disarray. Every single state-owned corporation is in crisis or verge of bankruptcy. So what I would like to see is a politician that stands up and says, you know what, we've got serious problems. This is not getting better. We can't find any more honest cadres to deploy, so we're going to stop doing certain things and try and roll back the state.
You see, now, that last bit of what you just said, I heard Tito Mboweni say precisely that, right? I mean, did you not? You know, we may have watched a different medium-term budget policy statement, but Paul is reading this thing on the surface, not going to the second layer.
I understand some of Paul's frustrations here, but I think it's a reality check. I think South Africa, let's take a step back. If you look at this country, what's been happening in the last 5 to 8 years effectively, there's been no commodity super cycle, which is what helped us in the noughties effectively 10, 15 years ago. The consumer's been couldn't hold the economy up anymore because of all the regulations that's been taking place all over the world. Basel 1, 2, 3, from the bank's perspectives, tighter credit regulations for consumer lending as well. So the consumer hasn't been able to hold the economy up. And it was left to government in the last 2-3 years to hold the economy up.
And government has done that with a blank checkbook, a book full of blank checks, and has borrowed money to do it.
It's come to an end. 100%. It's come to an end now. Government needs to pull back. It can only happen after elections. The current president of the country needs a firm mandate. Needs at least 60% of the vote to have a firm mandate from the populace, effectively, to say, right, clearly I'm now in charge, because he's not really 100% in charge right now. We all know that. I'm in charge, and I'm going to take the bull by the horns, and I'm going to start reducing government, because government needs to be reduced effectively.
If you reduce government, though, if you reduce what has been keeping the economy going, and then you say we're going to go back to what Tito Mboweni suggested, 25 government departments, 25 ministers, deputy ministers, fewer cars, fewer lunches, less expenditure, fewer civil servants, and we get the wage bill under control, well, then that's the safety net of the economy gone. What happens then?
Good point.
What happens to the economy then? Because the private sector is not yet ready to pick up the slack.
Correct. So it's got to be done in conjunction with a policy framework that is very clear and very transparent. That will allow private business, who's sitting on a lot of cash at the moment. We can see that everybody's making ill-considered, terrible acquisitions offshore.
I want to talk about some of those.
And we'll talk about that a little bit later. But if that cash can come back into the economy, and we need a policy framework that is very clear, very transparent, guys will start investing back in SA, and there's a lot of opportunities in South Africa as a result of that. So as government becomes smaller and shrinks, the corporate sector will start to grow again.
Paul's huffing and puffing, which is never a good sign. Huff and puff away.
There's not going to be any wholesale investment if there is the prospect of expropriation without compensation. The land issue is not something that Mr. Ramaphosa and his special committee can wish away. They keep saying, no, no, there won't be this, there won't be that. The problem is not the Constitution. There is nothing wrong with the Constitution. The problem, again, is implementation. Land reform has been a mess because it's another element of incompetency by central government. So that's going to be a problem, and it's going to remain a problem also for anything to do with agriculture and anything to do with the market. The property market is also in the doldrums. So I'm not so optimistic. I'm concerned that if the ANC gets another 60%, it's just going to be the same old, same old. I would argue that this country needs to, you know, look seriously at its political choices and perhaps come up with some other ideas.
Becoming a bit of a lobbyist, as Paul Theron. Let's focus on markets and money, shall we? Because that is territory with which you're intimately familiar. I saw on social media this week as the JSE went from there was an intraday peak in November 2017 to its low point as markets opened this Thursday morning. There'd been a 20% drop, which officially then would put us into bear market territory. These things are movable, but generally, if a market goes down 20% in any single cycle, it's regarded as a bear market. Are we in a bear market? How much of it is self-induced and how much of it is from the outside, Paul?
Look, it's about share prices. And the problem, of course, with share prices is they're ephemeral things. They're based on buyers and sellers in the market. And in recent months, we've seen a dire lack of buyers. So when some trouble blows in, whether it's your hamburger chain in the UK or your hospitals in Switzerland or your asset in China, I'm talking about Naspers, there are no buyers. You know, the market is being driven by sellers, and a lot of them international sellers. So I'm afraid we're in an unhappy place. We've seen big, blue chip, wonderful companies getting an absolute paddywhack in the market on a daily basis. It's very disconcerting because it's almost like there's nowhere to hide.
And now I want to get back to a point, hopefully by the end of this, where we put our razor blades away and we start talking about opportunities, because it is darkest before the dawn. I mean, we may not be anywhere near dawn yet, I don't know. Ron, when we look at the level of markets at the moment and the huge loss of confidence, there's a loss of national self-confidence in South Africa, but there's also this global lack of confidence. As Tito Mboweni started speaking on Wednesday in his medium-term budget policy statement, the bond rate, the R186 government bond, was trading at 9.06%. Borrowing was getting cheaper, and suddenly it spiked up to 9.31, and then into Thursday over 9.4%, meaning government's borrowing rate is rising. Borrowing rates rise when markets lose confidence or confidence dissipates, and that has been shown to be quite clear.
100%. Okay, let's start with global. So, I mean, effectively, we think a lot of the sell-off is related to global issues effectively, and it's all about interest rates. It's all about the fact that the world is now normalized post-GFC. You're having a return to normal, especially in the US. And I've
forgotten what normal is. Normal was 10 years ago.
Normal means growth is above 1%,
okay,
effectively. So US growing 3-4% is actually super normal. So interest rates need to be normalized, and interest rates are starting to rise globally, and that's shocking markets at the moment. Effectively, that withdrawal of dollar liquidity has shocked the global system.
But it was always going to happen, and this is what's so frustrating about markets, Paul Theron, is an entirely predictable event is now playing out, and that is that eventually inflation will start kicking in the world's biggest economy. As inflation starts kicking in, the Central Bank of the United States, the US Fed, starts to raise interest rates. This isn't exactly CNN breaking news.
Look, I wouldn't complain too much about global markets. We've seen a fantastic run, and even now we're only, you know, sort of single-digit figures below the all-time highs. So for me, global capitalism is not in some kind of state of crisis. In fact, I would far rather own the shares of a company like Apple or like Johnson & Johnson or Visa or Nike than I would bother with buying the bonds of some third-rate, badly run sovereign state, including, incidentally, the United States of America.
Their own bonds, you wouldn't buy their bonds?
I would definitely not buy US 10-year treasuries because that country is run by an absolute idiot. Fat Nixon, remember him, Donald Trump. He has totally debased the US fiscal regime. He has brought a massive tax cut at the tail end of the economic boom, which is resulting, we've seen it this last month, in severe fiscal deficits in the United States of America. They're running massive.
Which then leads to the next
overspending.
predictable event, which people, including Greenspan and others, are beginning to caution that we're coming to the end of a market cycle, and whether or not there's a bubble that is going to be popped, or whether or not there's just a slow puncture on global markets. Are we going into a 2 or 3 year bear market, hiatus in markets?
Look, it's difficult to tell, so you can't really actually tell whether this is the end of the cycle or just a healthy correction. We think it's a healthy correction. We think effectively what's going to happen right now is markets are panicking. So you've got the Fed tightening, you've got the EC potentially tightening as well, you've got Trump and his crazy trade wars, which is absolutely insane and crazy. They really don't need to do that effectively. So you've got authorities, governments and monetary authorities that are actually tightening this global economy effectively. And markets are starting to panic. Global growth is slowing and markets are panicking. The moment the Fed starts to panic and starts to maybe put a halt to interest rate hikes, and the ECB potentially
Donald
doing
Trump,
that,
I mean,
and him stopping as well,
calls him, is
100%.
putting huge pressure on the.
And I think this is the moment now when the S&P is down 10%. It needs to be down another 5 to 10%, and Donald Trump's going to panic. And the moment he panics, he's going to actually de-escalate. And that's going to be the turning point for markets, we think. And we think it's a buying opportunity. Not right now, potentially. If you want to stomach more volatility, get in there now. Global markets is probably where the place you want to be in. But if you want to wait a little bit and try and finesse, wait for central banks to panic, wait for Donald Trump to panic, and that'll be the buying point.
Good guidance this evening. More market movers for the month of October. Some big movers, some big stories. Gourmet Burger Kitchen, a 2 billion rand albatross around the neck of famous brands, which reports results next week. That is coming home to roost, that albatross. And we'll talk about Paul's favourite company in South Africa, if he's still talking about it, and that is Naspers. Peaked this time last year, but was actually in November at 4,090 rand a share. You can pick them up this week on sale, 2,600, maybe less, in a moment.